Welcome back, everybody. This is the first discussion video for Chapter 10, but I thought I'd start with a few sort of look back and review type questions to get us going here. First up, planning budgets are prepared at the blank level of activity for the period, while flexible budgets are generally prepared at the blank level of activity when used for performance evaluation. So think about that along with our Chapter 8 and Chapter 9 concepts. Pause the video here and then come back for the solution when you're ready. The best answer there is B. Planning budgets are prepared at the expected or planned level of activity, while flexible budgets are generally prepared at the actual level of activity when used for performance evaluation. If you recall, the flex budgets are a way to recalibrate or reset expectations based on what our actual activity level was, so we can make better apples to apples comparisons in terms of that performance evaluation. Next up, when preparing the master budget for the current period, your firm expected to produce and sell 50,000 units of your loan product. Demand was greater than expected, and your firm produced and sold 60,000 units. Which of the following variances would definitely appear on your firm's flexible budget performance report for the period? So look over these possible answers, pause the video here, and come back for the solution when you're ready. So the best answer there is C, an unfavorable activity variance for direct materials costs. It's the only one that would definitely appear on that flex budget performance report. Reason being, activity was greater than expected. So for any cost that varies with activity or volume, we would expect an unfavorable activity variance. Again, unfavorable in this context doesn't necessarily mean bad, because it just means our activity was greater than expected, right? Costs should increase, again, for anything that moves with activity or volume. Just to kind of mention a couple things about the other possible answers. The first one there, favorable spending variance for fixed supervisory cost, that could appear for sure, but there's no indication, no other information to suggest that it definitely would. We don't have enough to determine whether that would show up or not. Same idea with this letter B, favorable revenue variances. We may have one if we were able to increase the price of products unexpectedly, bill customers more than expected for some other reason. But again, no information to indicate that that would definitely show up. And then D said unfavorable cost plus pricing variance for variable selling costs. I'm not aware of any such variance, the cost plus pricing variance, so can't definitely say that that would show up either. Next, given what we know about cost behavior, which of the following would not be flexed in the flexible budget and so would be equal in the flexible and planning budgets? Again, give this some thought, pause the video, and when you're ready, come back for the solution. The answer there is D, property taxes for the firm's factory building. The only things we don't flex in the flex budget or adjust for changes in activity or volume are fixed expenses or fixed revenue items if we had any. So property taxes certainly are fixed with regard to volume or activity. So they're our only candidate there for not being flexed in the flex budget. And then the last one for now, Alt's Tile Installation Corp measures its activity in terms of square feet of tile installed. Last month, the actual level of activity was 1,270 square feet. The company's owner budgets for supply costs, a variable cost at $3.50 per square foot. The actual supply cost last month was $4,980 in total, and the spending variance for supplies was $535 unfavorable. There was also an activity variance for supplies of $315 unfavorable. What must the budgeted level of activity have been in square feet for this period? So pause the video, work through that, and then come back for the solution when you're ready. So the answer there is C, 1,180 square feet. We know that we had an activity variance of $315 that was unfavorable, and that would come from comparing the flex budget to the planning budget. We also know that that variance would consist of the $3.50 per square foot expected cost of supplies times the difference then between the activity in the flex budget, the actual activity, and the activity in the planning budget, the planned activity. So because of that, we know if we take the $315 unfavorable variance and divide by that $3.50 per square foot expected cost of supplies, that means the difference between actual and planned activity must have been 90 square feet. Since actual activity was 1,270 square feet, 1,270 minus that 90 square foot difference means our budgeted level of activity or planned level of activity must have been 1,180 square feet. Well, that brings us to our new material for Chapter 10 here, Chapter 10 titled Standard Costs and Variances. So from a managerial accounting perspective, when we say standards, we're just referring to some kind of benchmark or norm for measuring performance. We have two main types of standards commonly used in management accounting: price standards and quantity standards. Now, just as the name implies, price standards specify how much really should be paid for some unit of input. So we'll have price standards for materials, for example. Quantity standards, on the other hand, just specify how much of the input we should be using to make the product or provide a service. And again, we'd have quantity standards for materials, also for things like labor and overhead usage and so on. Now, in terms of setting our direct materials standards, typically we'll have a standard price per unit, which encompasses the final delivered cost of materials, so net of any kind of discounts, also including any kind of costs of procuring that material, getting it to us, and so on. We'll have a standard quantity per unit as well, summarized in some kind of bill of materials. It says how much we should be using of these inputs to make one unit of product. Similar idea for setting direct labor standards. We should have a standard rate per hour, and that should reflect some kind of mix of wages of the folks who work directly on our individual products as part of that production process. All the assemblers and finishers and whatever other roles are part of that production. We'd also have a standard hours per unit. We may use some kind of time and motion study or some kind of process engineering approach to get a better sense of exactly how long it should take under normal circumstances to produce one unit of our product. And then, as I alluded to, we'll also have variable manufacturing overhead standards. So we'll have a price standard, and that would be based on the rate, the variable portion of the predetermined overhead rate, and a quantity standard as well. Now, a quantity standard for overhead would be based on the allocation base for those predetermined overhead rates. So if you recall from earlier chapters when we had allocation bases like direct labor hours, machine hours, and other measures of time or volume like that. So we're saying here the quantity standard would be based on that. So one unit, say, takes 1 hour of direct labor. If the allocation base for overhead is direct labor hours, then our quantity standard for overhead would be the same, 1 direct labor hour per unit. Now, typically a manufacturer would summarize all of these standards on a standard cost card or record, and it might look something like what I've got included on the slide here. We're going to have our inputs one by one, direct materials, direct labor, and then the variable overhead piece. We'll show the standard quantity, and if we're talking about a time measure, that's standard hours essentially. Then we'll show the standard price or rate per unit of material or per hour of labor and so on. And then a standard cost per unit, the product of those first two things. So for materials, for example, here we're saying the standard quantity for whatever this is we're making is 3 pounds of raw material at a standard price of $4 per pound. So a standard cost per unit of the finished product, 3 times 4 or $12. And then same idea for labor and overhead. As we saw in chapter 9, but didn't really explicitly talk about, these standard costs per unit for materials, labor, and overhead can be used to come up with our activity and our spending variances. Remember, activity variances were those variances driven by changes in volume or activity between our expected level and our actual level. Spending variances were variances or differences caused by something else, the way we used our inputs or the price of those inputs. Now here in chapter 10, we're going to take our spending variances and break those down even further into price and quantity variances so we know a little bit more about where those differences are coming from, rather than just saying it's something other than activity. Now we'll be able to say, well, some of it's due to a change in price of the input, Some of it's due to a change in usage of inputs. And that's illustrated here on our general model for variance analysis. We're going to take those spending variances from Chapter 9 that we introduced with our flexible budgets and break those down into a price variance, so a difference between the actual price we paid for an input and what that standard price is, and then our quantity variance, the difference between the actual quantity of the input we used, whether that's materials, labor, overhead, and the standard quantity that quote unquote should be used in this production. Now, price and quantity standards are determined separately and kept separate for at least two reasons. The first, possibly the biggest, responsibility. We want to make sure that we understand what's driving this variance or this difference that's affecting the bottom line, so we can figure out who to talk to first. For example, the purchasing manager in any manufacturing setting is responsible for raw material purchases. They're going out and negotiating contracts with suppliers, making sure they can procure enough raw material in the marketplace to support production. So that person is considered responsible for the price paid for those materials, those inputs. On the other hand, the production manager is responsible for scheduling people to work on the assembly line or the production line. They're responsible for the general operations of that production process. So really, they're more responsible for the quantity or the amount of the material used. And if we show that we have a price variance in a particular period, that purchasing manager should be the first person we talk to about that. If we have some kind of quantity variance, the production manager should be our starting point. Doesn't mean they're always at fault or anything like that. It just gives us an indication of where we can start to investigate these differences. The second reason is around timing. So the purchase of materials and then the actual usage of them typically do occur at some kind of different times. So materials purchases could certainly sit in inventory for a while before actually being used. And if we can isolate the price variance at the time of purchase versus a quantity variance as these things are used over time, gives us a better shot at addressing any kind of shortcoming or inefficiency in our process related to those things. Now, here in our lower level variance analysis, we're going to have price and quantity variances for all three of our manufacturing inputs that vary. So materials, labor, and overhead. For materials, we call the price variance a price variance. For labor and overhead, we technically call it a rate variance. Quantity variances for materials we call quantity variances. For labor and overhead, technically we call them efficiency variances, but they essentially mean the same thing. Price variances are all about the price we're sort of paying or the cost we're incurring, per unit of output for those three things. Quantity variances are all about usage. How much of this stuff am I using or consuming as part of production? We also have a new type of budget to talk about here in Chapter 10. So I've laid out here on this slide a 3-column approach to this variance analysis, but this isn't the same 3 columns as we had in Chapter 9. First point being that all 3 of these are referring to the actual level of output. So if you recall in Chapter 9, when we started to look at activity variances and then revenue and spending variances, we had our planning budget as still part of that analysis, and that was put together at the expected level of activity. Now here we're talking about everything that occurs at the actual level of activity only. If I look at the far right column here, the standard quantity allowed for the actual output at the standard price, this represents our flex budget. That's no different than our flex budget. Flex budget said take our revenue and cost formula, right, and flex it for the actual level of output. That's exactly what we're talking about here, and incorporating our standards as far as quantity and price per unit of output. On the far left, I'll jump over here for a second. This is still just actual results, our reality, what really happened. So actual quantity of input, how much stuff did we really use in production? And then actual price, what did really pay for it? What we have that's new in the middle, I'm going to refer to as the as-if budget. And that takes the actual quantity of the input, but at the standard price. And the sole purpose for this as-if budget is to be able to isolate or separate or disentangle differences driven by price in a price variance on this side, and differences driven by quantity or usage in a quantity variance on this side. It's also worth noting that because this far left column represents our actual result, and this third column is synonymous or a parallel or equivalent to our flex budget, these two lower level price and quantity variances net out to form, if you will, our spending variance from Chapter 9. So we still are making that connection back to our original analysis in Chapter 9 where we just compared an actual result to our flex budget. Now we're diving a little deeper and saying, hey, if I insert this as if budget based on my standard price, but the actual quantity I've used of this input, I can disentangle or separate that spending variance into these two other more informative lower level variances, a price variance and a quantity variance. And I'm going to work through some examples here for sure. And then this is just summarizing what I already hinted at. This actual quantity of input, we're talking about the actual amount used of direct materials, direct labor, and variable overhead. The standard was the standard quantity allowed for the actual output, again, based on all these standards we talked about earlier. Actual price, just what we really paid. And then standard price, what we quote unquote should have paid for that input on a per input unit level. So let's pause or step to the side here for a second and think ahead a little. A blank materials quantity variance occurs when the actual quantity used in production is blank than the standard quantity allowed for the actual output of the period. Pause this, look over those potential solutions, think about what you've read in Chapter 10, and then come back for a solution here. The answer there is B. A favorable quantity variance occurs when the actual quantity used is less than the standard quantity allowed for the actual output of the period. Right? We're using less than the standard says we should have, so we'll have a favorable quantity variance. If we're using more than the standard said we should have, we'd have an unfavorable quantity variance. Next up, if skilled workers with high hourly rates of pay are given duties that require little skill and call for lower hourly rates of pay, this will result in a favorable labor rate variance. Is that true or false? Again, think about what we've kind of covered so far here in Chapter 10. Pause this and think, and then come back when you're ready for the solution. The answer there is false. If we have folks working on tasks, they're getting paid more than the people who are working on that should be paid, at least in theory, then we're going to have an unfavorable labor rate variance, right? The rate is going to be higher than it should have been, all else equal. Now that brings us to our first official learning objective here for Chapter 10, and that's to compute the direct materials price and quantity variances and explain their significance. I'm going to use an example here for Glacier Peak Outfitters. Let's say Glacier Peak has the following direct materials standard for the fiber fill, some kind of down alternative maybe, in its mountain parka or jacket. It should take 0.1 kilograms of fiber fill per jacket, and that stuff should cost $5 per kilogram. Let's also assume that last month 210 kilograms of fiber fill were purchased and used to make 2,000 jackets, and the materials cost a total of $1,029. I think it's helpful, especially early on, to kind of default to laying out the three-column approach when we're looking at these things. We've got our sort of flex budget equivalent on the far right, the standard quantity and the standard price, again for the actual level of output though. The far left, the actual result, actual quantity, actual price, and then in the middle of that as-if budget, actual quantity and standard price. So here for Glacier Peak, we know that we're making 2,000 jackets. Those things should take, just to back up and reiterate here, 0.1 kilograms per jacket, and this stuff should cost $5 per kilogram. So in terms of that flex budget, we've got the 2,000 jackets times 0.1 kilograms per jacket. We should be using 200 kilograms of fiber fill at this production level, times the standard price of $5 per kilogram for a total of $1,000. I'm going to jump over to the actual result here. We were told that just in total, we spent $1,029 on this 210 kilograms of fiber fill. So 1,029 was our total. If we want that on a per kilogram basis, we could take 1,029 divided by the 210 kilograms that we purchased and used, and there's our $4.90 per kilogram. Now the as if, again, we're taking the actual quantity, so the 210 kilograms that we bought and used, but multiplying it by the standard price, $5 per kilogram, what we should be paying, and that's a total of 1,050. Now we'll start here on the right. The difference between the as if, 1,050, and the flex budget equivalent, $1,000, is $50. That's our quantity variance for materials. The as if is greater than the flex, so that's unfavorable. The other thing you can kind of do to check your direction there of your favorability, just look at the usage, right? We should have used 200 kilograms. We actually used 210. We used more than we should have, or more than the standard, so we better have an unfavorable quantity variance. Now flip over to this side. The price variance is the difference between that actual result, the $1,029, and that as if budget, the $1,050. So that $21 represents a favorable price variance because the actual amount was less than the as if amount here. Other thing we can do again is look at the price of the input. We should be paying $5 per kilogram according to the standard. We actually got this stuff for $4.90 per kilogram, paid a little bit less than standard, so yeah, we should have a favorable price variance. We can also come up with these variances using this sort of factored equation approach. And I know for a lot of folks this tends to look a little messy, kind of looks like too much algebra. And I'm right there with you. I prefer to just lay it out in the columns and make sure I can fill in what I need. But to go through this quick, the materials price variance, right, is going to be the difference between that actual result, the AQ times the AP, and that as if amount, the AQ and the SP. So if we simplify that, we can pull out the AQ, the common term, and we've got the actual quantity times that difference in prices, actual price minus the standard price. So in this case for Glacier Peak, the 210 kilograms, the actual quantity, times the difference between the $4.90 actual price and the $5 standard price, 210 times the, if you will, negative 10 cents per kilogram, gives us a $21 favorable price variance. Similar idea for that materials quantity variance. It's going to be the difference between the as if, the AQ times the SP, and that flex budget equivalent, the SQ times the SP. We'll pull out our standard term, or our common term, the standard price, SP, and we're looking for the difference between the AQ and the SQ, the difference in the quantities or the Qs. Standard price of $5 times the difference between the 210 kilograms actually used and the 200 kilograms that the standard said we should be using. $5 times 10 is $50, and there we are with our unfavorable quantity variance. Again, this use of the as-if budget solely exists for us to be able to disentangle these two separate variances. Okay, on this side, we're isolating the difference in the P's only, right? Kind of look at the top here. AQAP, AQSP, the difference is the P's or the price, so that drives our price variance. Similar over here. Difference is in the Q's, though. The AQ in the as-if versus the SQ in the flex budget equivalent. Our differences are only in the Q's or quantities, so that drives our quantity variance. So let's get back to this idea of responsibility for a second. When we have this price variance, as we did with Glacier Peak here, $21 favorable, it doesn't seem like a huge amount, but we'll leave that aside for a second. What we're saying is the purchasing manager should be our first point of contact. They're the ones that negotiate the price with suppliers. They're the one responsible for writing the checks when it's time to buy the materials. So we're going to start there and say, hey, was that price variance, is that something of concern? In this case, well, it actually worked out in our favor. We're paying a little bit less than we should be according to the standard. Is that something we can sustain in the future? We've been able to get some kind of volume discount. You know, who knows what's going on. On the other side, saying who's responsible for the materials quantity variance, we'll start with the production manager. Why did we use more fill in this case, more of this raw material than we should have according to our standard. Was there excess waste? Was there rework because people were not trained properly to do their job? What's going on? There's a ton of different possible explanations, but the production manager should be our first point of contact. The other thing worth pointing out is because we're using that as-if budget to disentangle the two separate lower level variances, we are using the standard price to calculate the quantity variance so that we're not commingling or confounding the potential sources of those variances. That way we can point to the production manager and say, I know exactly how much of this overall difference is caused by a difference in usage, and you're my first point of contact for that. Now, just because the production and purchasing manager are our first points of contact for the quantity and price variances respectively, it doesn't mean it's always entirely controllable by them or their department. Just as a quick example, the production manager in some cases may schedule production in a way that takes some kind of change in delivery of materials. Maybe they're doing everything on too tight of a schedule. We need express delivery, which gets more expensive, and that may lead to an unfavorable price variances. Similarly, the purchasing manager might be purchasing lower quality materials. So in our particular case with Glacier Peak, yeah, they got a price break. Maybe they got, lousy material, and that required excess rework because of quality issues. And that might not be the responsibility or the fault, if you will, of the production manager. So again, we can't say unequivocally that just because we have a price variance, it's the purchasing manager's fault, or that we have a quantity variance, it's the production manager's fault. But it does give us a first point of contact to start to investigate these things. Okay, let's try another practice problem here before we call it quits for this video. Magno Cereal Corp uses a standard cost system for its crunchy pickle cereal. Sounds delicious. The material standard for each batch of cereal produced is 1.4 pounds of pickles at a standard cost of $3 per pound. During the month of August, Magno purchased 78,000 pounds of pickles at a total cost of $253,500. Magno used all of these pickles to produce 60,000 batches of cereal. What is their materials quantity variance for August? So pause the video, work through that, and then come back when you're ready for the solution. The answer there is B, 18,000 favorable. So I did use sort of the factored equation approach, if you will, for this. But again, I encourage you, if you'd like to prefer to use the sort of full column approach, especially while you're getting started. Quantity variances, we're looking for differences in the Q's. Right? So actual quantity minus standard quantity times that standard price will get us there. In this case, the actual quantity is the 78,000 pounds of pickles. We're going to subtract from that the 60,000 batches of cereal we made times the standard of 1.4 pounds per batch. This represents the standard quantity in total, right? Times that $3 standard price. So we do some of that math out, we get 78,000, the actual quantity, minus 84,000, the standard quantity, times that $3 standard price, or negative, if you will, $18,000. So we're saying that we have an $18,000 favorable quantity variance. We should be using, according to standard, 84,000 pounds of this stuff to make 60,000 batches. We actually use 78,000 pounds, so we've got a favorable quantity variance there for August. Let's actually do one more here. Suver Corporation has a standard costing system. The following data available for June. The actual quantity of direct materials purchased, 24,000 pounds. Standard price of materials, $6 per pound. Materials price variance, 6,000 unfavorable. Materials quantity variance, 2,400 favorable. The actual price per pound of materials purchased in June was what? So working a little bit backwards here. Pause that, work through the problem, and then come back for the solution when you're ready. So one way to do that would be, again, to focus on the variances. We had the materials price variance of 6,000 unfavorable, which we know would be represented by the actual quantity used times the difference in the P's or the prices. Actual price minus that standard price. So I've plugged in some numbers here. That means 6,000 unfavorable variance would be equal to 24,000 actual pounds used times the actual price we don't know minus the $6 standard price. Doing a little rearranging, that means the actual price minus $6 here would be equal to 6,000 divided by the 24,000 pounds. And that means the actual price when I back solve for AP here must be $6.25. That wraps up the first discussion video here for Chapter 10. Back up and review any portion you need. Let me know if you have any questions and then move on to the next.